When markets go down, it's hard to watch the value in our accounts decrease as well. It can even cause some to second guess if they're doing the right thing. But if we spend just a few minutes preparing our portfolio for scenarios like this, we'll have a much smoother ride and more confidence with our retirement plan. But if we keep managing our portfolios the same way we did the last 30 or 40 years, and we don't start designing the income withdrawal strategy, that could open us up to a lot more retirement risks that could and should be avoided. So in this video, I'll go over a simple way to prepare taking withdrawals in a market downturn. My name's Dave Zoller, and I own a retirement planning firm with Tim and Luke and Sean, and we get to help a lot of people design their ideal retirement. If you've been working with an advisor for some time and you're starting to realize that retirement has a whole new set of planning strategies, but maybe it's not their specialty, you're welcome to reach out to us, and you can do that through our website to have a free call with us. We don't always have space, but you'll definitely hear from me either way. So on to step one of how to take portfolio withdrawals in a down market. And I'm going to keep this very simple here in high level, and then also share a free tool that you can use to check this for yourself. So step one is to think about using the bucket approach by segmenting the different investments into conservative and growth. Just to keep it very simple, really take the pre-tax accounts like your IRAs and 401ks, and then look for all the individual holdings in there, and then put them into two categories, that conservative and growth. If you're not sure if they're conservative or growth, then I'll walk through that free tool to help you do this pretty quickly. But historically, assets that could fit into the conservative bucket have been cash or money markets or certain types of fixed income. Now, the reason why we're doing this is for really just one purpose. During times when the stock market is down, it's great to have investments in asset classes that are not down as much as, say, stocks. And you know the reason why, because it's much easier to use those conservative assets that you've got that aren't down as much for income. What we don't want to do is be forced to have to sell one of those investments or funds that's down the most. Instead, letting those, the growth bucket, stay invested and hopefully give it a chance to get back to where it was. Now, one way to think about it is how many years of income do you need or want in that conservative bucket? Some people, they like having a year's worth of cash available for expenses coming up, and then maybe 3 to 4 years worth of income in the conservative investments. And then some want less or some want more. And by the way, sometimes I share stories of how other people are doing this and finding success in their retirement plans in our weekly 5-minute retirement email. So if you're interested in that, you can find it below. One way we help clients figure out what the right amount to have in the conservative bucket is really by first figuring out their income plan. And it looks something like this. This is really their entire financial life and retirement plan in one visual, so that we know what rate of return we need for the plan to be successful. And it allows us to model out many different scenarios, like higher than expected inflation, or if expenses change, or if you did a Roth conversion strategy. And it shows us the result before we actually make the decision or before it happens. And that really guides us to what we need in conservative assets in that conservative bucket. One mistake that we see people make quite often is how much they put into the conservative bucket and really put in more than what's needed. And they end up losing more to inflation than they really should be. Even though this is simple, there's a lot that goes into it, but for the sake of this video, I'm gonna keep it high level, and I'll move on to how you can identify the conservative and growth investments in the accounts that you have right now. It's done with a free site called Portfolio Visualizer, and I'll include a link to it below. And I've mentioned this before, but I'll walk you through just in case you're not familiar with it. So I'll give you an example. So once you have your statements or your online accounts, you can start plugging in the name or the ticker symbols here. And let me get to there. It looks like this. So as you plug in the names and ticker symbols here, and then assign the weighting that they have, what percentage they take up of the portfolio, get everything in there. And again, this is just examples. This isn't recommended allocations or anything like that. It's just an example to show you what the next page looks like. So once you do that, then you click Analyze Portfolio down here. And there's a lot of interesting info here if you're a nerd like me, but just to keep it simple, you can skip straight to the Assets tab up here. Here we'll see that you can get an idea of what are the conservative in assets, and then what might be the growth ones by looking at this one here, max drawdown, or maybe looking at what the worst year was or what the best year. And you can kind of start to see in this scenario, there are a few that don't seem to have as big a swings. Now, one thing to note here is you want to look at how long the fund has actually been around as well, because you want to make sure it has a good track record and time period just to see how it's done in both good and bad times. Once you do this, then you should have a pretty good picture of what might be conservative, what might be growth, and then the next step is really figuring out how much you should have that can fit into that conservative bucket. And then after that, identify how much you're going to be withdrawing from your investments as a whole in retirement. And then that can give you an idea of how many years of withdrawals you've got in that conservative bucket. Again, I hope you understand that we're just keeping it at a high level here. There's a lot that goes into designing these allocations that's the right fit for your retirement plan, but this should at least give you an idea and help in deciding how to take withdrawals during market corrections or maybe bad markets. I hope this was helpful. Please like the video and think about sharing this with a friend who's close to retirement as well if you think it might help them. And if you like retirement specific videos like this, subscribe so that I see you in the next one. Take care.